In this video, I'm going to share with you guys 3 easy steps to trading trend continuation. This is the same strategy that I traded not only my live account, but also my 20 Apex funded accounts and my 3 funded My Futures accounts. As a friendly reminder, if you want to check out either of those prop firms and you want to ensure you get the best deal, check out the link in the description box down below. Now, just to show you guys, I'm not cherry picking these results. I'm recording this video on August 24th. You'll be able to check that out by the release date of the video. And the chart examples we're going to be using is going to be from August 23rd, which is a Friday, just to show I'm not going back in time to cherry pick it. And this is a strategy I've been trading for quite some time. Now, let's talk about step number 1. Now, step number 1 is we need to learn how to identify the trend. I'm going to make this very, very simple. I'm going to use 2 moving averages. The first one in blue is going to be a 50 period exponential moving average. The second line in yellow is going to be the second moving average, which is going to be the 200 period moving average. Whenever I see the blue line above the yellow line, then I know we're in an uptrend. However, I also want them pointing up in roughly a 45-degree angle. So what I'm saying is when they start flattening out like this is not what I'm looking for. I'm looking for when both the moving averages are rising. Now to the downside, it's just the opposite. When the blue line is below the yellow line and they're pointing downward, then I'm looking for selling opportunities to the downside. All right. So step number 1, very simple, as long as you're not colorblind. And if you are colorblind, this is not a jab at you because I am partially colorblind myself, but you can actually go to each of the moving averages and you could change the way they look. So for example, if you had a hard time seeing colors, you can make one line as a solid line and one line a dotted line. And again, you just need to be able to distinguish between the faster moving average and the slower. Also, a characteristic of the faster moving average is you'll see it wiggle around a lot more. The slower moving average will not be as erratic. It will be nice and smooth on its movement more times than not. All right, so now that we've identified step number 1 in terms of should we be bullish or bearish, where are we actually looking to enter the market? Well, for this example, I'm going to use another tool called Bookmap. Now, maybe you guys have another way of getting this same information, but what I have found is Bookmap by far is the best, in my opinion, at displaying order flow data, more specifically level 2 data. Now, I want you guys to go ahead and pay attention to something real quick. So in this example right here, we have identified the trend is in an uptrend, right? That was step number 1. Step number 2 is once we're in an uptrend, where is the resting liquidity at? So this is gonna be step number 2. If you look right up here at 19,700, we see this is in red, this red horizontal line. Now, this red horizontal line represents resting liquidity in the market, AKA big orders, and the market tends to be attracted towards that liquidity level. So we want to think about this as a runner target if we get into this trend continuation pattern. So if we look, we've identified the moving averages are moving up. Now let's talk about where we look to get into the market at. Now, if I see an example, and I'm going to show you guys the criteria to enter here in just a moment, I do not want to look for a bullish setup when we're way away from the moving average. Meaning if I get a buy setup up here, I do not want to take it for the simple fact that when the market is trending up, quite often, what do? We push away from the moving averages, we come back to it. We push away, we come back to it. We push away, we come back to it. We push away, we come back to it, so on and so forth until we finally reverse and we start going back in the opposite direction. Now, what I'm going to do on my chart real quick is I'm going to highlight this resting liquidity order right up above us. And I'm going to go ahead and thicken the line up a little bit, make it a nice lime green, green for money. And this is going to be our target location. Now, how do we know that? Again, we found that level off of Bookmap, but still it doesn't answer the question. How do we know when to get into the market? If we've already identified that anywhere near the moving average or below is a good entry point, now all we need is an order flow event, which brings me to step number 3. Now on step number 3, it's going to be very simple. Look at how the price came down. And I want you guys to focus on the size of the bubbles. Now, a bigger red bubble basically signifies there was more aggression on the sell side. A bigger green bubble represents more aggression on the buy side. Now, one of the things I want to see is I want to see the market come down. However, when we get towards the moving average on the chart I was showing you guys a few moments ago, I do not want to see a big red bubble. Instead, I'd like to see a small red bubble or even a small green bubble. So in this case, we get a red bubble, we pop back up, but then we come back down. Now see this little green bubble? It just touches the top of the red bubble. And as soon as we start breaking back above the top of that green bubble, and we're gonna say that price point is 19,668. Actually, we're gonna round this up, 19,668.50. and that's going to come in about 934.08. Now I'm going to simply draw a white line across that same level. Notice how close we still are to the moving average. So we're looking to enter the market right here. Guess where our stop loss is? Right below that swing low that we just set. So when we come back over and look at Bookmap, just think about this larger red bubble. My stop loss is right below that red bubble. Now that red bubble also correlates, like I said just a moment ago, with the swing point right here. So let's look at this, right? We can have a stop loss and we'll actually round down a little bit. All right, that's only 1.75 points. I'd probably want to go a little bit bigger than that. And we'll give it an extra couple ticks. For this example, we'll give it 10 ticks just in case we spike back below that a little bit. But what's great about this is if we enter right here, guess what? We want to front run liquidity, all right? I'm not looking to target right at liquidity. I'm probably going to front run that by, 4 to 12 ticks or so. So I'm going to move that down here just a bit. And let's measure from here towards the liquidity. That's an additional 2.5 points, aka 10 ticks or so. Now notice we are risking roughly 3 points in this example to try to make 16.75 points. And this is something that can be repeated time and time again. And no, this does not just work on the long side of the market. So what I'm going to do now is I'm just going to fast forward here just a bit. Now, before I show you guys the sell side example, if you guys are wondering what time period chart I'm using, we talk about this all the time in the live stream. This is a Rinko chart. More specifically, it's Ninja Rinko. Now, if you're trading with any of the prop firms out there, even if it's not the ones I personally trade with myself, but they give you Ninja Trader access, you can download this exact Rinko bar type for free. I'll leave a link in the description box down below for that. I have no affiliation with this company. It's just a product that I use. And this is the same chart setup that I share with you guys each night that I stream Monday through Thursday at 8:45 p.m. So now let's go ahead and look at this example over here. Now, let me ask you this question. Is the blue line below the yellow line? 100% certainly it is. So what was step number 2 that we mentioned about earlier in the video? Keep in mind, this is a 3-step process. Very, very simple. So if I know we're in a downtrend, we have to start looking for liquidity. Now we have a major liquidity down here, right about 19,600, but we have another one up above it about 19,612. Now in this type of situation where I have 2 resting liquidity orders, I am more times than not going to target the larger liquidity that is closest to price. Why is that? Because it has a higher probability of being hit. Now that resting liquidity is going to be down here at 19,612.50. So now I'm going to grab this same green line that we use for the buy side trade and come all the way down here to 19,612.50. Now keep in mind, if I'm off by a tick or so on the resting liquidity area, it is not that important to me. You might say, Mike, why is that? Because I'm going to be front running it as a target anyways. Because a lot of times when we get this big, large resting liquidity order, the market gets scared before we ever get there. We know we have the trend in a downtrend. So let's go over and look at Bookmap. Do we have any entries somewhere around 12:40 in the afternoon to about 12:41 and a half? Now let's come over and look at Bookmap right around that time, 12:40 to 12:41. Well, as we start pushing up, do we see any small bubbles right up here? We most certainly do. Now, the first entry could have been about 19,679, which will put us right below this dot over here. And look, we did come back up and we tested this small dot right here. We tested it again with an even smaller dot, which means there's even less aggression on the buy side of the trade, aka it would be very easy for the market to flip back down and go ahead and continue in the direction of the trend and try to go ahead and hunt that resting liquidity that we have below us. So in this example, if we look to enter the market, I'm going to run this down to about 19,679. Our stop loss of 3 points, that would put our stop loss right up here about 19,682, which is small bubble right over here would not have taken us out. So let's go ahead and visualize this on the chart that we would be trading from. Now, if you look, this white line right here represents where the entry point would be. I'm going to zoom this up a bit just so you guys can see it. And what do? Here was that second push right up. We didn't even get above the 200 period moving average. Boom, slams right back down. Now, if you're looking to enter where this white line is, all right, if you're trading multiple contracts, you might say, Mike, I don't have enough margin to trade 2 minis. Well, you can trade micros as well. But if you're trading multiple contracts, you peel one off, stop loss goes to break even. And guess what? You're looking for your runner target. And look, right down here is the first runner target. And let's see, did we actually make it down towards a larger liquidity at 600, which we did not? So if we measure from our entry point all the way down here, and we're going to front run that liquidity down there, that is 63 points on the NASDAQ, with one single trade. And this is why if you trade with a trend, you can get outsized gains. Keep in mind, you make 63 points in this trade example, and you're only risking 3 points. Now, you don't have to be right that often in order to be profitable with this type of reward to risk ratio. Now, not every trade is going to be 63 points. There are going to be losing trades as well. Now, if you guys would like to learn more about Bookmap, I do have a link in the description box down below, but also check out the playlist right here, and you can see more ways that I use Bookmap to trade order flow.